everybody. Welcome back to Cup of Joe. I am Joe Gallimore, Director of Investment Management with Argent Bridge Advisors. Hope everyone had a wonderful Easter weekend or a long weekend if you were not celebrating the Easter holiday. And it's good to see you again. So March closed out Q1 and the month ended up being an oddly similar microcosm of the quarter itself as a whole. So the month of March started out on a short uptick and then declined sharply through the middle of the month due to the well-documented failures of both Silicon Valley and Signature banks. But then the month closed out with a very strong finish. So the S&P 500 returned positive 3.7% for the month of March, and almost all of that return came in the final week, specifically the last 3 days. So the way this is similar to Q1 is that Q1 started in January with a very strong month, then declined through the middle, basically all of the month of February, as things cooled off from the super hot January, and then recovered a lot of January's gains in the month of March for the reasons we just talked about. So Q1 ended, the S&P 500 ended Q1 positive 7.5%. And most other equity indexes were also up mid-single digits for the quarter. So that's a great start to the year. I think we'll all agree. Now, in the midst of the strong finish to March and Q1, economists stood up and became very vocal of impending economic slowdown due to lots of softening data. So more recently, last week, in the first week of April, we saw a decidedly risk-off sentiment take over the stock market. Stocks cooled off, and the U.S. aggregate bond index, which had returned 3% in the first quarter, added a whole nother 1.1% in just 1 week here to start Q2. So this elevated its return so far this year to over 4%. Roller coaster of a quarter, roller coaster of a month. What are some lessons we can take away from this experience? The first is this was a very good, not so subtle reminder of do not try to time the market. Market timing is a losing proposition, which is essentially an established fact in the investing world at this point. Q1 was a great example of the roller coaster of emotions that a market timer has to be concerned with. And in this case, they had almost no predictability to them. So just know ahead of time that you're going to stay invested and then stay invested, and you'll have history on your side just about every time. Okay, and the second lesson I think we can take from the first quarter is that asset allocation, once again, is hard at work in your portfolios. In times of stress in economic environments and certainly world environments, different asset classes can tend to move in the same direction. We saw this last year in 2022 when we experienced the highest inflation in over 40 years, and both stocks and bonds declined. But now that asset prices have repriced and interest rates are in basically a whole new time zone than they were a little over a year ago, different asset classes are now each facing their own set of circumstances rather than all being affected by the same thing. So the different indexes that we're all watching together on these Cup of Joe segments, they're all moving in different magnitudes and even in different directions from week to week. And this is a very good thing. Bond investors are once again being rewarded with some meaningful income, and even savers are experiencing some decent yields on their cash investments. So that's good too. So a diversified allocation whose primary goal is actually to just limit your risk, is now currently working to provide multiple sources of return in your portfolios. So those are the silver linings to this manic first quarter, and hopefully we work through a lot of the economic slowdown and see a return to some market growth soon. If you have any questions about these, please feel free to reach out by email or give us a call, and we will do our best to provide you with clarity. Have a great day. Thank you.